Good morning. We're here to talk about the Silicon Valley real estate marketplace for the first week in January of 2026, the week ending Friday, January 22nd, presented Saturday morning on the January the 3rd. These are the key chapters we're going over and their associated graphics. Let's get into the first data slide. This is looking at three major components. The first one is the purple line that's bolded for you. That's the turnover rate. How quickly do you take the turnover the market one time compared to what it typically is for this time of the year? So we're basically down here at about 96% of the normal turnover rate. So we're slightly faster than we normally are. The time it would take to sell the existing inventory one time is 4% faster than it normally is. Well, all intents and purposes, that's the normal marketplace. The next slide we'll look at is the offers accepted. That's the orange line, the brown orange line down here in the bold color. You can see that that's around 74%. That's starting to get to the level where it'd be concerning, but it's been at this level basically since the 2022 price correction. Price correction happened right here, right around Valentine's Day of 2022, where we had been, since the pandemic shelter in place was lifted with the restrictions, we were selling 20% more than we typically do. But then when we got to the price correction of 2022, we lost that 20% surplus, went down to about a 30% deficit where we were only selling 70% of what we normally do, came up in 2024, and we're basically at 20% missing, only 80% of our volume. And we've been basically at that same 80%. Now, what's different about this year is the variation has been more. We've got all the way up to 88% down here, and we were all the way down to 70%. Our swings have been greater than they were in 2024. And now 2026, we're starting off on the low side at about 74%. So you're missing 25% of the market currently, and you can see that the amount of missing market has been increasing. The percentage of the full marketplace has been decreasing since fourth quarter, all through fourth quarter. That's a pretty just steady decline. Really can't tell what's going to happen going into the future. And the third and final one on this graph, which goes all the way back to January 1st of 2016, is the inventory. So what is the level of inventory? And inventory is only 80% of where it normally is. So not only are we missing 25% of the buyers, we're missing 20% of the sellers, which keeps the market relatively in balance. It's the supply-demand ratio, and so your supply is down and your demand are down, and so you're just selling less transactions than you normally do. Now what we're doing is looking at more metrics only over the last quarter. Middle of the graph, right down here, is this current line. The purple is the current data. The blue line is the data that favors the buyer the most, the blue line. The red is the line that favors the seller the most. And the gray line is exactly where you'd expect the market to be. On turnover rate, you'd expect the market to be right where it is, right on the gray line. It's a little bit faster turnover, a little bit quicker turnover than normal. And that's why you're just a hair under the gray line if you look at it closely. A quarter ago, we were at 101%, a little bit slower than normal. And now we're basically 97%, a little bit faster than normal. But notice the raw count, the actual number went from 45 days to 33 days. People think of the holidays as a slow time. There's less volume, but the volume that does sell actually sells quicker right now than it did 13 weeks ago. And you can see that the market actually slows down again. Right now is one of the fastest paced marketplaces. We do then pick up in a couple more weeks. And part of this is just the imbalance. We have to have the sellers come on the market before the buyers can have the opportunity to buy it. Related but different is marketing time. This is how long does it take 3 out of 4 sellers to sell. You can see that here you're significantly above the blue line. So you're taking longer than the longest time you'd expect. And if you come over to the right side, that's where the current data is. You can see that the purple is 51 days. So right now, 3 out of 4 sellers are taking 51 days to sell, just over 50 days to sell. Normally, we're only at 39 days, and the longest you'd expect is 44 days. The long typical seller, the seller that isn't pricing their home to sell in the first weekend, and I'm not criticizing that market strategy, it's just that there's a significant number of the sellers that participate in that. That really doesn't look at it. What you're looking at is the sellers that don't participate in that ask market rate or a little bit above market rate and wait for the buyers to come in. How long is that typical seller taking? And right now they're taking 51 days. That's still less than 2 months, which in most parts of the country would be considered a fast-paced marketplace. But for Silicon Valley, that's fairly slow. Again, normal, we're at 39. The most you'd expect is 44. We're a full week longer than that. And when you're talking about 6 and 7 weeks, a whole week longer is significant. Moving on to price reductions. This is what the seller does to bring in the offer. Their original list price is being reduced by 1.3% overall. That's 44% greater than normal. So normal, we're down around 90%. And so when you take 44% of 90%, you get to the 132%. And you can see the magnitude right now is roughly the same, 1.33%, 1.34%. So just up 0.02%, which we're now really splitting hairs. On a percentage basis, we've actually improved, and you're down to only 34% larger price reductions than normal. In rough terms, at this time of the year, the price adjustments are normally 1%. And you can see that we've gone up. You can see the gray line's going up, and you can see that you're between the gray line and a cool marketplace. Next is buyers overbidding. What are the buyers feeling? And a quarter ago, we were overbidding 4.2%. Typical is 4.8%. So back here, you can see, and it's really tough to see, but try to get that close, but not block it. You can see the gray line comes straight out, and then the purple line goes down. So this last week, the gray line, the purple line was below the purple, which is a lower reading and favoring this buyer, and a less overbid as buyer. So you know the 4.2% overbid is what the buyers were doing versus the 4.8% that they typically do. Then once we get past that 13 weeks ago and get to 12 weeks ago, you can see the purple line and the gray line are mirroring each other very closely. And right now you're actually overbidding. It's still at roughly that same 4%, but normally the amount of overbidding drops down to 3.6%. So buyers are actually feeling more competition now than they normally do, which is why if you look at it carefully, the purple line is just above the gray line. So there's a little bit more, the buyers are feeling more competition than they normally do. So even though we're missing 25% of the volume of transactions and 20% of the inventory, the buyers are still feeling the pressure when they get that house that they want to buy, and they're still overbidding. They're overbidding just slightly more than they typically do for this time of the year. Real estate's very cyclical, and that's why I compare everything to this time of the year. Offers accepted. A quarter ago, we were 2,100, which was 85% of normal. We're missing 16% of the marketplace. Now we're only at 937, so you've lost more than 50% of the marketplace that we had a quarter ago. And we've also lost a percentage. We're now at 74% of normal. Where we normally are is 1,268, and the least number of offers you'd expect is 921. And we'll see that up when we get to the slide later in the presentation on offer counts. The offer counts are now again at a record low for the past 25 years. So this past week, I think we've had the fewest number of offers accepted of any time in the past 25 years, which I think is worth tracking and paying attention to again. Inventory is 2% more than normal, so exactly normal. We were at 2,700. We're now at 85%. So you can see that you've lost 20% in just the last 13 weeks. And you can see that the purple line was following. And right here is where it broke off 3 weeks ago. So 2 weeks ago it was lower. Last week it was significantly lower. And this week it's significantly lower. So just the last couple of weeks. And that could be a calendar event. With Christmas and New Year's both falling on Thursday this year, it basically turned what was, a significant one-day holiday into a 4-day holiday, with people really not coming on the market for Friday. So I think we may see a return to the level of a normal inventory, at least in that direction, next week. Well, because I'm expecting sellers to come on the marketplace this coming week. But anyway, right now you're missing 19% of the market. We only have 903 listings, and the number of transactions, you can see that you're at 81% at 2,000. We're now only at 1,300, and we're only at 67% of the volume that you'd expect for this time of the year. So you can see that the volume of closed transactions has really dropped down the last couple of weeks. One of the advantages of looking at the data weekly is it takes 3 data points to do a trend. If this trend really continues into next week and the week after, that's when you start really getting a little concerned about it. What I expect to happen is a rebound in the number of transactions. Now, number of transactions is going to lag more because it requires a closed transaction, because until it's actually closed, you can't count it, because we have what we call transactions that fall through. Moving on to the micro market areas, this is a summary. On the far left-hand side here is the current conditions. The green are the same conditions, but comparing to normal. If you look at it, when you look at just the raw numbers, you have a fair amount of red. You have a fair amount of blue, but I would say you have slightly more red than blue, but it's a pretty close to balanced marketplace. It's basically fairly typical. But now if you come over and look at the green highlights at the top, that's where I compare the metrics to the same week for the last 10 years. And you can see there's almost all blue. So you're basically saying that the marketplace is favoring the buyers more than it typically does. although it is still a good seller's market, or at least a balanced marketplace. And then as you go further over to the right, you have the light shaded green up here, which is offers and active listings. And they're shaded because they're significant. Supply and demand is probably the most significant metric, but by themselves, they really don't tell you anything. Raw count for the number of listings or raw number of offers really doesn't tell you anything unless you know the sample size. And for example, I've been pointing it out because Foster City's been behaving very weird. Right now, we have 4 times the normal level of inventory that you'd expect. You might think, my God, that's huge. And it is huge, which is why it's solid blue. But you're only talking about 8 listings. One of the disadvantage is we've had a long-term trend of decreasing inventory, transactions, inventory, just the volume of transactions, which doesn't really make a lot of sense. When you have growing population, you'd expect the number of transactions to increase. What's really saying is the buying and selling public market is getting a lot more stable. The people that are in the houses are staying for a lot longer. So we're having less transactions than we were 25 years ago and 40 years ago. And then the far right-hand columns are appreciation, which is since the last 9 months of 2015. So you can see red here is just the areas that have the highest appreciation. The area that has the highest appreciation, the micromarket areas there, is the Campbell, Willow Glen, Cambrian, Santa Clara micromarket area at 96%. It's got the highest out of all the different areas. And then the last column is the price. And instead of following the median price, which is the middle number, I follow the cheapest 10 percentile in the area, as well as the most expensive 90 percentile on the very far right. And so you have a sandwich, you have a range of price expectations in each micromarket area. Here's some more detail for those that want it. Here's the turnover rate in days for Silicon Valley. Don't want to paint gloom, but this is how quickly you're turning the marketplace over, and it's fairly fast. It's going to be a shade of red if it's between 1 and 6 weeks. So in these areas that are all red, you're going to sell out your inventory in 1 to 6 weeks, which is a very fast-paced marketplace. Now, if you look at the eastern part of Alameda County, basically the Tri-Valley area, that's where the market really slows down. Livermore sitting at 94 days, Pleasanton sitting at 112 days. And that's starting to be a significantly lengthy marketplace. I consider anything to be over 3 months to be a long marketing time. Now, 3 months in a lot of parts of the country is still a reasonable and would be sort of the hot side of a balanced marketplace. And I'm calling that the balanced side of a cool marketplace. So, it all depends on what you're used to. Here's the turnover time compared to normal. So even though the previous slide was right, or at least shades of red for most of it, here is looking at marketing turnover rate compared to normal. You can see that Alameda County is having basically the normal turnover time. Most of the bay side of San Mateo County is having normal marketing times. There are a few areas, like the affordable areas in Santa Clara County, are having a slower, longer marketing turnover time. And there are a few areas sort of in the center part of Santa Clara County, and believe it or not, over in the coast, where they're having a quicker marketing time. And the reason the coast is surprising is not long ago, they were taking twice as long as normal, and now they're taking just about the normal amount of time. And I do need to go back and wonder why that is red on the graph and not red over here. The not red over here makes more sense, because 98% you would not expect it to be red. Basically on 12%, so this is color coded incorrectly. Apparently that should be white in color, which makes a little more sense. So the only area that's hot in color is sort of the Cupertino, Sunnyvale, and the Saratoga Los Gatos area in Santa Clara County. Everybody else is either white or blue in color. The color codes over here are more accurate than the color codes on the map for some reason. Okay, I misread it. I was reading Foster City. So back to the previous slide on the turnover rate. Foster City is only at 2/3 their normal time, so they're turning over 1/3 faster, which is why it's red, and that's why the map and the legends do match. I was puzzling on myself on how the legend and the map could be different, and I was misreading it. Here's marketing time. This is at 3 out of 4 sellers. So most of the valley is white in color, so we're taking roughly the normal amount of time, which is between 3 and 6 weeks. You can see there's one area that's red in color, which is Foster City, very small area. They're turning over in 11 days. And that's for 3 out of 4 sellers to sell. Your 8 sellers, 6 of them should sell within 11 days. And then you have a couple areas that are blue in color. The affordable areas, the eastern part of Alameda County, that's probably Oakland up here in the blue. And then you have the coast, you have the expensive areas in San Mateo County and Saratoga Los Gatos that are all taking longer marketing times. And that's in just raw count. here is raw marketing times compared to the 10-year normal. So where's the market compared to normal? You got a fair amount of the eastern part of Silicon Valley is hotter than normal. You got a couple areas that are blue, slightly blue in color, which are taking longer, but overall it's white in color. And you got some blue, you got some red. It's a balanced marketplace. So marketing time is exactly what you'd expect it to be. Here's seller price reductions. So what are sellers doing compared to price just in raw numbers? This is a very tight metric, as you can see from the index up here. From 0.25% to 1% reduction is no color at all. From 1 to 5% reduction is blue. From 0.25% reduction to 0.5% increase is red in color. So here you're having basically a slight increase in price, 0.1% for Santa Clara Willow Glen. Foster City is having no adjustments whatsoever. Pleasanton, believe it or not, with their long marketing time, the sellers now are only coming down 0.1%. The areas that are having the biggest price reductions are the expensive areas in San Mateo County, the San Mateo County coast, and Oakland. Everybody else is sort of a balanced marketplace. So balance being either white in color or a very faint shade of pink or a very faint shade of blue. So there's a lot that are favoring the blue, and there's more blue than there is red. So this would say sellers are taking slightly more price reductions than they typically do. And here's price reductions compared to that 10-year median. So where are they taking more? They're taking more in the areas that are blue. So the real affordable areas of Santa Clara County, even all of Santa Clara County into the Tri-Cities area of Alameda County is having a faint shade of blue. And then you have the coast, which is taking large price reductions at 93%. So they're taking 7% more price reductions than they typically do. Over here in Livermore, you're taking larger price reductions. But again, surprisingly, in Pleasanton, they're taking less price reductions than they normally do at 3%. 100. This is the frequency of those price reductions. So how common are price reductions? I think we got down here to Oakland where 1 in 3 sellers are taking price reductions. You get up to the expensive areas in San Mateo County and the San Mateo County coast, and they're taking 50%. So 1 in 2 sellers in these 2 areas over here, the blue areas, are taking a price reduction. Every other seller is taking a price reduction. Up here in Oakland, it's 1 out of 3. Over here in Livermore, it is 1 out of 4 sellers. Pleasanton, though, it's only 6%. So very few sellers in Pleasanton, which is sort of unusual to have long marketing times with few sellers taking price reductions. So you either have sellers in the blue areas that are taking price reductions or sellers in the red that aren't taking price reductions. And then about 1/3 of the marketplace is white in color where the sellers really are taking normal price reductions. So I'm not sure what you make out of that, your balance, but you got the extremes. You got larger, normal, and less than normal, all roughly even on the map. Here's frequency of those price reductions compared to the 10-year normal. So what are they compared to normal? Red would be less than normal. So good part of central part of Silicon Valley, Redwood City, and Pleasanton are all taking less price reductions than normal. Very few areas are taking significantly more. San Leandro, and Hayward are taking more. The coast are taking more, and the expensive areas in San Mateo County are taking more price reductions than normal. And that's the frequency. So it's more frequent than normal in those 3 areas. Here's the overbidding. So where's overbidding? This is just what a buyer is doing. It's pretty by 9. No strong colors. The one area that stands up here is the island of Alameda, the city of Alameda, at 15% overbid. So you're asking $1 million, or up in that area, well, actually it's probably about $1.5 million. But you're asking, $1 million or $2 million for your house. You're getting 15% over that. That's $150,000 to $300,000 more than your asking price. It's not insignificant when you start paying 15% above the seller's ask price. You'd expect to negotiate down, not in Silicon Valley. In Santa Clara County, 6.5%. In Los Altos, Palo Alto, 4.5% in the moderate priced areas, Santa Clara, Willow Glen, Cambrian, and Campbell. So a lot of overbidding is still happening. Here's the compared to normal. You can see, even though there's a lot of overbidding that's happening, it's clearly less overbidding than normal, which is why most of the areas are blue. There's a couple areas that have a faint shade of pink. Alameda, again, has the most at 3% more overbidding than normal. And 3% may not sound like a lot of extra overbidding, but if you're overbidding normally at 14%, you'd be overbidding at 17%. So if I remember the number correctly, I think it's 15% this year, which means your normal amount of overbidding for the island of Alameda is 12%. So they've gone from 12% to 15%, because this is raw count, not a ratio. Here's the frequency of overbidding. So how common is overbidding? Areas that are overall, you can see Silicon Valley is at 52% of sellers getting overbid, so slightly more than 50%. Santa Clara comes in at 51%. San Mateo comes in at 50%. And Alameda County is coming in at the highest at 53% overbidding. And there's quite a bit of range in each county. In Alameda County goes from 21% in Pleasanton up to 64% in Berkeley. In San Mateo County, it goes from a high of 64% in Pacifica to a low of 16% on the coast. And in Santa Clara County, it goes from a low of 23 in South County to a high of 68% of the sellers getting overbid in Cupertino and Sunnyvale. So each county has a huge range, which, is one of the reasons why I'm a firm believer in you need to look at micro-market data and not in countywide or regional data. Here's the frequency of overbidding. This is a very nicely blue chart. So basically overbidding is less than you would expect it to be. This is the frequency of it. So, Pleasanton is only half the overbidding that you'd expect, the frequency. But you go to Union City and Newark in the same county, you're 10% or at least 9% more overbidding than normal. And I think that's the highest in the whole area. Cupertino has 7% more overbidding. And then within the same Santa Clara County, you have the East, Central, South, San Jose, the affordable areas, at only 20% less than normal. So you got a 30% range change. But overall, you look at this map and buyers are overbidding as far as magnitude, but they're overbidding less frequently. Here's the appreciation. What areas have had the most appreciation? Sort of the areas that are affordable and have a reasonable commute to the job points. San Mateo County is mostly blue because it lost that premium for being close to work after the pandemic. The one exception is Redwood City is now back in the red. But you can start seeing the different areas on where the appreciation has been the most and where it's been the least. Here's the affordability, just the prices. So now you can clearly see what everybody has in their mind. The expensive areas in the red, sort of the West Peninsula of Silicon Valley, and the affordable areas, sort of the eastern foothill slopes, whether it be up in Alameda County or down in Southern County in Santa Clara County. And again, and instead of just following the median price, which most people do in the middle, I sandwich that with the cheapest 10 percentile in a given area and the most expensive 90 percentile. So you have a sandwich, you have a price range to expect in each area that you're looking in. Here's the percentage offers. So you can see that we're having less offers than normal. The only pink area is right here in Cupertino, where they're actually having 32% more offers than they normally do. You can see that Silicon Valley overall at 74% is missing a fairly significant marketplace. So to have an area that's 32% more offers, you're having a lot more activity in a concentrated area. And when you also have this, Cupertino is an expensive area, so that pulls up the median for the county without pulling up property values in any given area. And then in San Mateo County, you have the San Mateo County coast, where it's got more offers than normal. It's actually got 17% more offers than normal, not as large as Santa Clara's example, but still more than normal. And then active listings, where do you have a surplus of inventory? We have a surplus of inventory in Foster City with 400% of their normal level of inventory. But as I pointed out, that's 8 listings instead of 2 listings. So you got to keep both things in mind. It's a very small micro market area. And again, here's a summary that we talked about at the beginning of the micro market data. I won't go into it again here. Here's some information for those that need more details. And now what we're looking at is the major components for Silicon Valley. So we're taking all 3 counties in a blender. We're looking at the raw data in the purple. We're comparing it to where it typically is. This is the turnover time. So turnover time is completely normal. And if you notice, it looks like it's done a V, just like it's done in the 10-year data, just like it's done in the cool data, and just like it's done in the hot data. So the market looks like it's turning around, and I would expect marketing time to go up next week. Why? Because the number of new listings is increasing quicker each week, and the new listings have to be on the marketplace for a period of time. And you can see that's going to go on until about the 3rd week in January, and then marketing times are going to come back. This doesn't mean the market's slowing down. It just means the way the data is calculated, the market appears to be slowing down. Here's the turnover rate compared to normal. So we actually are a little bit faster turnover time. So your market, the pressure the buyers are feeling is faster than normal. You can see how it's improved in just the last 3 weeks. Here's the typical marketing time. So how long does it take? And one thing that marketing time does not take into consideration that the turnover rate does, the turnover rate takes into consideration the sellers that come on the market and are on the marketplace that don't sell. Marketing time you have to have an offer before I know how long it took you to sell the property. So this only includes the successful sellers. So marketing time for, if you looked at time on the marketplace with active inventory, which is not what I do, I look at offers accepted, that would be a much higher number than this 51 days that we have right now. But you can see it's been climbing, but it normally climbs at this time of the year. And that's why it's so important compared to what you expect it to do. Now, I expect it to continue to climb for a couple more weeks, and then I expect it to plummet downward. And why would I plummet it downward? Because all the new inventory that's coming on this coming week, the week after, the next 3 or 4 weeks, are all still coming on the market with 0 days on the marketplace. That's what's going to be selling. That brings down your average. Here's compared to typical. So marketing time is 30% longer than normal. You'd expect, if you're normal, you'd be down here at the 100% line and just flat. And you can see that we've gone through some significant oscillations on this data point, where earlier in 2025, we were basically on fire, and then we were really slow. Then we got back to normal, and now we're a little bit slow. We're sort of on the high end, 40%, sort of the high end of what you'd expect this number to be, and we're at 30% longer than normal for the typical seller to sell. Here's the sellers that are taking the largest price reductions. I actually like this number, and I understand it's not normal. I'm looking at the 97.5th percentile. So the seller that's taking the largest 2.5 percentile price reduction, what are they taking? They're taking a 14.5% price reduction, which is not small numbers when you look at the magnitude of our pricing being, somewhere around $1 million to $2 million to $3 million, depending on what price range you're in. When you're talking 14% of those numbers, it's a significant chunk of change. So right now you're at 14%. You're between a cool marketplace, the blue line down here based on the past 10 years, and the typical. Here's the average. So this grounds me back to, the same thing. But so many of the sellers do no price adjustment at all. That 14.5% price adjustment turns out to be a 1.35% price adjustment when you look at it on the average, because you're bringing in a whole bunch of zeros, and that makes the magnitude of the number fairly small. But that's what it is. You can see you're favoring the buyer right now on the frequency of price reductions, so the magnitude. Here's compared to the 10-year normal. So sellers are taking bigger price reductions than they normally do, and you can see that we're in the white area on this graph. Here's the frequency of those price reductions, so more frequent price reductions. But how common is it? It's only 21% of the sellers are doing a price adjustment. So sellers continue to do their homework and price their home to the price where they expect it to sell when they go on the marketplace. Here's the frequency compared to normal. So we're still doing more frequent price reductions, somewhere around 10% more than common. So 10% more sellers are doing a price reduction than typically do. Here's the overbid. So this is looking at what the buyers are doing. This is the median overbid. This is the one graph in my whole presentation that's median versus average, I believe. And you can see your median is getting very close to 100%. And that's exactly why I typically don't use it, is you'd expect it to be at 100%. And you can see back here, before we had the pandemic, we spent significant periods of time, like 2 quarters at 100% and a quarter here at 100%. But it's interesting to know that, half the buyers are paying more than 100%, half are paying less. But that average was, I forgot what the number was, 4.1% or something like that. That's why you need both numbers. The typical, half the buyers are paying market value or ask price or less, half are paying more. But when you average that number, just like average sale price is higher than median sale price, it's at 4% over. Here's the typical overbid. So now if you were doing the overbid at normal, you'd be at 0. And I wish I remembered the numbers. I think they were like 4.6% is the amount of overbidding currently, and 4.2 is the amount of overbidding we were expecting. So you're 0.4% more overbid than you would expect. Here's the frequency of that overbidding. How common is it? You can see that you're less overbidding than you normally are. Normally you're up here at something like 56% of the sellers getting more than their ask price. Right now you're down at 52%. Still more than half the sellers are getting their ask price, but 4% less sellers getting more than their ask price than normal. Here's the frequency compared to normal. So you can see that you're down here at about 92% of the normal frequency of overbidding. Here's a pricing model on log paper for you. I'm basically saying the market went up at a 12.5% for about 7.5 years, 7.25 years. And then for about the last 4 years now, prices have been basically flat. Yes, they were definitely lower in the latter half of 2022 and first half of 2023. But if you simply ignore that 1 year period of time in there, you basically are flat. Yes, there's periods of time when you're higher, there's periods of time when you're lower. Some of this is property values and some of it is when the more expensive areas like Cupertino, Sunnyvale are selling them less. But Silicon Valley's median price is again approaching $1.5 million. We first reached that price point way back here in 2021. That supports to some degree that prices have been pretty flat in the recent years. Here's offers accepted compared to normal. You can see the offers accepted are right on the blue line, the least. You'd expect that to go down for one more week, maybe 2 more weeks, and then you'd expect it to turn around and start going back up. Here's the active inventory. You expect that to start going back up next week, and I do expect that to happen. We're probably at the bottom now, and next week's number will probably be higher. Here's some additional information. Turnover time compared to normal. So this is supply and demand, and now what I'm doing is I'm comparing all 3 counties. So you have Alameda County in the gray having the longest turnover time, Santa Clara County in the blue having the second, but basically tied with San Mateo County, and I'll call them tied in the orange. So you can see that your turnover time is from 32 days to a high of 36 days. So all fairly close together, so all very respectable. Here's typical time to sell. Santa Clara County shines in this category at only 39 days to sell out 3 out of 4 sellers. And then you have San Mateo County at the highest at about 657 days, and Alameda County in second place at 54. You might as well call them tied when you're talking about that magnitude. 3 days out of 57 is pretty small. This is ask price reductions. So even though Alameda County is doing the biggest price reductions at 1.75% price reductions, San Mateo County in the orange and Santa Clara are pretty close to tied. Santa Clara is at 1%. San Mateo County is at about 1.25% price reduction. Now we're looking at the frequency of price reductions in the 3 counties. Santa Clara County has the least frequent price reductions at only 16% of the sellers. That's roughly 1 out of 7 sellers. Then you have San Mateo County coming in at about 21%. That's about 1 in every 5 sellers is doing a price reduction. And Alameda County is coming in with the most price reductions at 26%, or 1 out of 4 sellers are doing a price reduction. So in the worst county, still 3 out of 4 sellers are not doing a price reduction in order before they get the offer in. This is the average overbid. So this is the average, the median we talked about earlier. You can see Alameda County has the most overbidding. That seems counterintuitive compared to the previous slides, where that had the longest marketing time and the most price reductions. But I believe what's happening is sellers are staying on the market, reducing their price, and they're reducing it beyond where the market is. So buyers come in and then overbid on that now reduced listing. And that's because my measurement is from the price at the time of the offer acceptance, not from the seller's original list price, which I could graph. But to me, it's more interesting to know how much pressure the buyers are feeling. And that's more the overbidding based on the current ask price. In second place, you have San Mateo County at about 3.5% of average overbid, and Santa Clara County has the least amount of overbidding at 3% even though it had one of the fastest turnover rates. The frequency of overbidding, almost a 3-way tie. I'd call it 52% of the sellers are getting overbid. San Mateo County is technically the best at 50%, Santa Clara next at 51%, and Alameda County has the most frequent overbid at 53%. So the frequency and magnitude of overbidding are greatest in Alameda County, even though they had the most price reductions. Here's the long-term appreciation, and Santa Clara County has the highest appreciation rate at about 87% since the last 9 months of 2015. Then you have almost a 2-way tie between Alameda County at 60% and San Mateo County at 65% appreciation, and that's since the last 9 months of 2015. Here are the median sold prices. Most affordable is Alameda County, now below $1.2 million. The first time it reached that level was back here in early 2021, right around second quarter break. Then you have Santa Clara County next at 1.8 million. The first time Santa Clara reached that price point wasn't until first quarter of 2022, so later than Alameda County. And then you have the highest median sold price is San Mateo County at about 1.9 million. And the first time it reached that level was like Alameda County, right around the second quarter break of 2021. So Santa Clara County has had the highest appreciation more recently, or it took longer to get to the first price point. Here's the same information on regular paper, and you can see very clearly San Mateo County is now just below 1.9, Santa Clara is at 1.8, and Alameda County is just below 1.2 million. And you can see that you have sort of this upside down U, or this N-shaped curve, every single year on pricing. Here's the payments taking into consideration the recent interest rates that have been drifting downwards ever so slightly. And you can see that more in Alameda County, where the payments have been pretty much drifting down since the second quarter break of 2025. Here's offers accepted. We're on the steep downward climb. I would almost anticipate one more week of down or almost level. You're sort of at the bottom of the valley before we turn around the week after. I expect a lot of new inventory this coming week, so I expect inventory to go up, but I don't expect the offers to be accepted in great numbers until after the weekend, after they're listed. And here is inventory. You can see it's coming down. And if you look back in the previous years, basically January 3rd is the bottom. So I expect the active inventory to be up higher next week with the increase in the offers happening the week after that. This is of interesting note. We now are down to 937 offers accepted, which is the second worst year out of the last 25 years and has the potential of falling below 904, which would make it the worst year out of the last 25 years. The 937 is current numbers, and some of these escrows are going to fail and potentially get below the 904. You can see that's happened up here. I think it's on this year, where just last week we were above 1268. I'd have to go back and check the numbers, and now we're below 1268. So last week, 2 weeks ago, and last week and this week are all the second worst out of the last 25 years. It is currently the third worst year, but the reason I did that is at 1097, with the worst year being, second worst year being last year of 1095, I'm very confident this 1097 will drop below 1095, and will do so just next week. So I went ahead and hedged it in a little early. Here's the data for Silicon Valley, Santa Clara, and San Mateo, as well as Alameda counties. You can pick the metric you are looking at or most interested in and see what the values are. You can see that the number of new listings is starting to climb up. We went up, well, 1% basically overall. Alameda County was exactly the same number, and I double checked that to make sure that was true. It's just one of those coincidences. But 1% growth, 1.5% in Santa Clara, 2.8% in San Mateo, and 0 growth in Alameda County. But I'd expect the total inventory is still drifting down, and total inventory is going to be close to 0 for next week. I actually expect the new listings to be up significantly, and I expect inventory to be up a little bit, and then offers up the next week. Here's some customization that I can do for buyers, adding in key things that a lot of agents don't provide, like links to the details, map, if that's interested, school ratings, school names, commute times, commute distances, whatever is important to you, the consumer, in the order that you want. We can customize this spreadsheet and then send that to you as new listings come on the marketplace. I'm Richard Calhoun, real estate broker here in Silicon Valley, working with buyers or sellers in single agency transactions. My contact information is here as well as on every slide. We have been talking and we'll continue talking about the Silicon Valley real estate market. About the last 8 minutes of this 50-minute presentation is on the Greater Bay Area, which is 5 regions, 13 counties. If you want the handout, I did get it up. I was a little late, about 5 minutes before 9 o'clock. I got it posted. The green root URL plus the letter H for handout, 2026-01-03. 0103 would be the link to finish it out. So the purple you have to change every week. This is the longer link from 2 weeks ago if you wanted to go look at that. I tried to update it. I was running late this week. The link, if you want to join Saturday morning live, you can do so typing in the green root URL plus the year 2026 and the purple, which changes every year. Or you can type in the longer blue URL if you don't like secondary direct links. The YouTube channel is down here. You can type in either the blue YouTube link or the shorter green root URL. Appreciate likes and subscriptions. Let's continue on with the distributions. Here's some details for those that are following along. Here now is the marketing time distribution. What you're looking at is anywhere from the 50th percentile, because the 50th percentile is very close together and really doesn't change much, all the way up to the 90th percentile. And we go every week for the first 5 weeks. Then we jump 2 weeks at a time after that. And then the most current 5 weeks are also 1 week at a time and 2 weeks after that. So what we do is we just jump in and see how the market goes. The dotted line is where we were a year ago, and that's where we're going to start off. The purple line is the current data. So you can see that the current line is probably it's clearly worse than we were a year ago. So we're taking longer than we were. So let's start. And again, we're starting off on the dotted line. Which ways to go? No real change. Then a huge decrease, significant decrease, increase. Now it went down, but it's got flatter. So that's why I called it an increase. Now you can see the whole line is moving up. When you're decreasing, the line on the right-hand side gets very steep. And as soon as you start flattening out, you're already slowing down. And you can see that basically all year you're marching along. Right about there is sort of the peak of the marketplace, or the coolness of the marketplace. Now you bounce for a little bit. Now you're actually heating up again, which is right. We did that this year, the month of September, I think it was. Now you're cooling down for the rest of the year. So what do I expect for this year? I expect the next week will be roughly the same level as the purple line. And then after that, I expect marketing time to go down. Why is that? This coming week, there won't be that many new offers accepted because this is the week we're expecting new inventory to hit the market. The week after now, about 14 days from now, I'll be reporting on a large increase of offers accepted. Those large increase of offers accepted will be based on the new inventory that doesn't have any marketing time, which causes the decrease. Moving on to the largest price reductions, here we're looking at from 2.5 percentile. So I'm ignoring the highest 2.5 percentile price reductions down to 17.5%. It's a 15% market slice downshifted by 2.5 percentile. The purple line is the current line. We're starting off on the dotted line, which was exactly a year ago. Let's start through and see which direction this market goes. It actually is heating up the very next week. So sellers are already to the point where they're not going to be doing price reductions. There's sort of the peak of the marketplace, February 21st. Then it's already increasing with more and more price reductions. So again, I expect fewer price reductions going forward. Basically, the sellers get optimistic. We're out of the holidays. We don't need to reduce our price anymore. And now we're coming up on the improvement, August 23rd, September 6th, there's the improvement, September 2nd, October 4th, October 18th. Now you're already slowing down November 1st. So it was September and October where we sort of heated up a little bit and some bounce there the last couple of weeks. And we're actually not at the worst week. You can see that it's just some of the weeks. So sellers have already shifted that mindset a little bit. We're past the holidays, or we're nearly past the holidays. Instead of reducing the price, we'll wait for the market to catch up to our asking price. Here's Overbid. This is the third and final distribution. Same concept, 1 week at a time, then 2 weeks at a time, and then finally 1 week at a time as we get close. We're starting at the purple line is where we are now, so we're clearly below the dotted line. So we're cooler than we were a year ago, so less overbidding. But let's see which direction we expect it to go. Basically, no change, no change, no change, a little cooler. Why is it going to be cooler a couple weeks out? Because there's a 3 to 5 week lag. The heat of the marketplace here is March 22nd and April 5th, which again is after that Valentine's Day typical peak, and that's because we need the escrows to close. When is the market going to accelerate? Well, here we are in July, cooling down. End of July, still cooling. We're into August, August 23rd. There's an improvement. There's an improvement. So we're having an improvement into October. There's an improvement November 1st, November 15th. So November 15th is sort of the peak of the marketplace of the acceleration. And again, that's because it was actually 5 weeks earlier than that. And then we've slowed down to this being the coolest gear line on this line. But last year was cooler. So what do I expect? I actually expect this line to continue to go down because we still have to look at the December transactions, the first week, second week, third week, fourth week, fifth week in December. Those transactions of when they were accepted, when we were going into the holidays, still haven't been reported because they're in it still pending. That's going to cause this purple line to drift down further down. It may become the coolest line that I sort of expected. So that gives you some idea. I expect it to be below the lowest dotted line on here. And the reason I expect it to be below is the purple line is below the dotted line from a year ago. Here's some information about the Greater Bay Area, 13 counties and 5 regions. These are the different regions here on the left, the different counties in those regions on the right. Let's get going. This is turnover time. Santa Clara County or Silicon Valley has the fastest turnover time, followed quickly by the cities, both under 40 days. We go from that to the North Bay, which is at 65 days, almost 67 days, then the Central Valley at 80 days, and the Central Coast at 85 days to turn their marketplace over once. So the marketplace for these 3 regions, North Bay, Central Valley, and Central Coast, is significantly slower. It's twice as long as it is for the cities and for the Silicon Valley. Here's the time for the typical seller to sell. You can see the same sort of order in general, but San Mateo County has longer marketing times than you would expect. Because remember, it was the Silicon Valley, then the cities, then the Central Valley, but the Central Valley and cities reverse on marketing time. So you can see they're not exactly the same metric. Again, the biggest difference is turnover time includes the unsuccessful sellers, and marketing time only includes the successful sellers. So it's taking longer to sell the successful sellers than it would for the which doesn't make a lot of sense to me on the fly, but that's clearly what the data is saying. You can see that Central Valley is doing a better job, and because, well, let's go back and look at it. Central Valley was 80 days and cities was 40. So this was 80 days and it's lower at 70. The cities was at 40, it's doubled to 80. So there's a sort of a role reversal or a data reversal. The Central Coast is the longest marketing time at over 100 and what's that, 102 days. North Bay at about 100, about 91 days. Cities at about 81 days. Central Valley at about 69 days. And Silicon Valley being the fastest at about 51 days for the typical seller to sell. And again, that's looking at 3 out of 4 sellers sell in that amount of time or less, or 25% of the sellers take longer than that amount of time to sell. Here's the average price reductions. Silicon Valley has got the least amount of price reductions. You can see that we're all over the place. A decrease in price reductions in the Silicon Valley and the Central Valley, an increase in price reductions in the cities, Central Coast, and in the North Bay. So you got a 3-2 split. What would I expect? Well, you can see that if you go back 1 year, all of them start taking less price reductions. And you can see that's a repetitive pattern year after year. So I'd expect these numbers to all start going up in as far as on the graph, which is a decreasing amount of price reductions. And this is the average. This is the frequency of those price reductions. The frequency I'd expect to start coming down at fewer and fewer sellers taking price reductions. It looks like we've already flipped over in Silicon Valley. It's the only region that I would call flipped over. Cities is clearly still increasing. Central Coast is still increasing. Central Valley is sort of flat and North Bay is flat. So 2 flat, 2 increasing, and Silicon Valley ahead of the curve and coming down. And you can see they all come down. They all peak right around the first of the year every year. And do keep in mind that the first 9 years here are on the condensed scale. Then all of 2025 is on the expanded scale, so you can readjust slopes and things of that nature. And the current year, 2026, is also on the expanded scale. Here's the average overbidding for each of the regions. You can see the cities has the most overbidding at 8%, Silicon Valley next at 4%, and then the remaining 3 regions are all below ask price. North Bay at about 0.25% reduction, Central Valley at about 1% reduction, and Central Coast at about a 2% reduction. Frequency of that overbidding, you can see that cities in Silicon Valley are tied at about 52% of the sellers getting more than their ask price. Then you jump all the way down to a third in the North Bay, 28% in the Central Valley, and only 22% of the sellers get more than their ask price on the Central Coast. Here's the appreciation. Central Valley has the highest appreciation. Silicon Valley is next at something like 75% appreciation. Central Coast at about 72%. North Bay at about 65%. And the area that's doing the least well is the cities at about 37% appreciation. And you can see that the cities has really broke off right after during the recovery of the pandemic and has done notoriously worse since then. Prior to the pandemic, they were all going up at about the same rate, which is what I would expect just in general. Here's the median sold price. You can see that each region is higher than they were back in 2016. But notice here, you have the cities in orange. You first reached the price that we're at now in first quarter of 2021. The purple line was first reached in second quarter of 2021. The Central Coast was first reached in the second period. The North Bay was first reached in first quarter, and Central Valley was first reached in 2021. So when you were looking at the global, bigger regional areas, they all reached the price they're at now, right in that second quarter of 2021. So we basically have had 4 solid years of no long-term appreciation. Yes, prices peaked right here in 2022, no doubt about it, and they valleyed out right in first quarter of 2023, but they've been basically flat since. Here's the estimated payments using the high balance conforming loan limit interest rate for the nation. It's just an arbitrary interest rate. In general, the jumbo rate, which is what most home buyers use in Silicon Valley, is lower than that. Here's the offers accepted. You can see you got 3. This is just raw counts. The regions are very close together. You can see that Silicon Valley has done the biggest decrease. It was up here at 1,000 listings and offers, and now it's the lowest. So it's gone from 2,000 to 1,000, where the North Bay and the Central Valley has only gone from something around 1,500 to something around 1,050. So dramatically less reduction. Same in cities is pretty steep compared to Central Coast, but the cities is nowhere near as the drop off as Silicon Valley. So Silicon Valley is more impacted by the holidays than the other regions. Here's the active inventory, and again, they're all dropping off. I do expect inventory to turn around and go up next week, just as it did in all these areas. And here's the numbers, slightly different presentation. You have the 13 counties down the side, as well as the 5 regions that are bolded. I also have the Bay Area raw data for you, for those want to compare the median numbers that are out there all the time. The other advantage of listening to this presentation too is you already know what the median price is for the month of December. You look at this week's median, and it's basically for 2 days in November, 31 days in December, and 2 days in January. And the difference, the now column is this current week with raw count, raw data. And then 1 week ago is the percent change. And 5 weeks ago is the percent change from 5 weeks ago. The yellow are your leading indicators. The orange are lagging indicators or no indicators, because sale price is just the value of the land underneath. And with that, we're finished. We have been talking about real estate here in the Silicon Valley with a high level overview of the Greater Bay Area. Appreciate any likes or subscriptions. And again, I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. These are the URLs that give you to the presentation Saturday morning at 9 a.m. or the handout or the archives on YouTube. Thanks for joining. Bye for now.